fxntradinggroup, what's up guys? Welcome back to the channel. Welcome back to another video. And as we continue our Blueprint Summit series, guys, we're going to go ahead and break down for you everything that has to do with EMAs. And at the very end, we'll talk about also ADR. So I hope you enjoyed this video as we continue to go through the Blueprint Summit videos.
Let's talk about exponential moving averages and what they are and how we use them, right? So exponential moving averages, the ones that we use are going to be the 5, the 13, the 50, the 200, and the 800. So every EMA that we used essentially has a purpose. So there's nothing that we don't use that essentially doesn't have a purpose, right? So the 5 EMA is going to be used to help extend the current trade that you're in. So if you want to try and extend out the trade outside more than 30 pips or whatnots, you can use the 5 EMA. And like we talked about, you're basically using it as a way to keep going, and you're just literally waiting for that to move across and close below, or price action below or above that 5 EMA before you get out. The next one is going to be the 13 EMA. That's used as an entry trigger, right? So we use that to enter trades. So if you're a conservative trader, you'd be waiting for like a 5 and 13 crossover, or if you're a more aggressive trader, then you'd be doing a 13 EMA close. So meaning price would close above or below the 13 EMA. That would be your entry point, of course, after a pullback. The 5 and 13 together, used as an entry trigger for taking trades. The 50 EMA is the balance line, and it basically shows the intraday trend. So every day, price action is going to interact with the 50, no matter what happens. So on a 15-minute chart, the 50 is always going to be interacting with price. And it's basically going to show you the intraday trend of what's going on, particularly that day. So you'll see a lot of times when price action bounces off the 50 throughout the Asian range, and it just literally continues throughout the entire day. So all of these EMAs also, they run as basically running support and resistance, as moving support and resistance. But the 200 EMA is used as home base. What do I mean by that? So if you ever notice on a chart, this is any chart, when price gets too far away from the 200 EMA, it always comes back to the 200 before going further up. So this reminds me of an important factor when we talked about resets yesterday. A lot of the resets that you see when you're coming off of a peak formation and you have the 1350 cross and all that good stuff, right? You'll see price come down to the 200, and then the reset happens to bounce off of the 200 before going up higher. So somebody asked me yesterday, is there a way to predict, when resets happen? And I talked about, when it breaks structure, when you're, let's say, waiting for a sell to happen, but instead you get buys instead. A second way to help confirm that early on is when you have that happen, but when it's happening also when you bounce off the 200 EMA on a 1-hour chart. The 200 also gives you the perspective of what's going on a higher time frame. So the 200 EMA on a 15-minute chart basically represents the 50 EMA on a 1-hour chart. So essentially, without looking at a 1-hour chart, you already know what the 1 hour chart is doing based on the 200 EMA, because the 200 is basically the 50 on the 1 hour chart. And finally, the 800 EMA gives you the perspective of a 4 hour chart, because that's basically represents the 50 EMA on a 4 hour chart. So without having to go and switch too far back and forth between 4 hour, 1 hour, 15 minute, if you stay on the 15-minute time frame, essentially you know what's happening on the higher 1 hour and higher 4 hour time frame, just based off of looking at the EMAs by themselves, at the 200 and the 800, because those represents the 50 EMA on that representative chart. Does that make sense? So obviously we use the EMAs for entry signals, or signals for entry. We also use them for target, right? For take profit targets. The 50, 200, 800, whenever they're below us or above us, when we're taking a trade. If we're taking a type 1 trade, let's say that's a sell, and the EMAs are below us, then we can clearly use them for take profits. The 50, 200, and 800 would be your take profit points. Same thing if you're trading, let's say, a W type 1 pattern, and the EMAs are above you, then you're going to use the EMAs as take profit points instead of just going for the standard 30 pip trade. Okay? Like I said before, they act as moving support and resistance. You're going to see prices bounce off the EMAs just like if they were literally support and resistance. And like I was telling you before, the 50 axis intraday momentum, it shows that to you on the screen. So let me pop over to the charts real quick, and let me show you what I mean. So here's what I mean with the thought of the EMA part. All right, so this is pound. This is what pound USD would look like on the right. This is what it would look like here on a 15-minute chart, right? So on a 15-minute chart here, look at where the 200 is right here, right? So the 200 is basically above price. So on the 1 hour time frame, this line here represents where price is on the 1 hour. So if you look at the 1 hour chart, here's the 50, right? And you can see the 50 is right above price. Same thing here where the 200 is. This represents basically where 200 represents where the 1 hour chart is on a 50 EMA. So if you look at, like, let's say a 4 hour chart, if you look on a 15-minute chart, here's the 800, right? That's literally right touching. It's literally touching the candle right here, right? So this 800 represents the 50 on a 1 hour chart or on a 4 hour chart. So look what happens on a 4 hour chart. Look at the 50. It's literally touching price right here. Same thing. So if we go back here, let's say, just to make it an easier visual. So if we look at this spot here on the chart, this range is basically like July 16th through the 20th. If we look on on the chart here, here's July 16th through the 20th. So what I want you to notice is essentially that spot and that spot. So this is a 15-minute chart. This is the 1 hour chart. Look at the 200, right? 200 is above price. This 200 line represents the 50 EMA on a 1 hour chart. So if you look at the 1 hour chart, the 50 EMA, this is what that 200 is representing. It's just basically telling you that, hey, on the 1 hour chart, price is well below the 50 EMA, which it is. Same thing on the 800 EMA here. If you look at the 800 EMA on a 15-minute chart, and then we look at it on a 4 hour chart on the same thing, you could see the 800 on a 15-minute chart is well above, obviously the 200 and everything like that. Well, the 800 here on a 15-minute chart represents the 50 on a 4-hour chart. So you can see it's just basically the same thing. It's just telling you that the 50 is still below price on a 4-hour chart. So these higher EMAs basically allow you to confirm the directional bias on a higher time frame without switching to a higher time frame. Because if you go to a 4-hour time frame and you see that price action is trading below the 50, that trend is down, right? Or the directional bias is a sell. Just like if you were to go on a 4-hour time frame and you were to see that the price action is above the 50, then clearly the direction, the bias is to go higher. Well, the same thing basically is on a 15-minute chart. Whenever you see 50, 200, 800, right, all of them, and price action is all below all of them, the directional bias is to sell. Now, the one thing that I want you guys to understand is that just because the directional bias is, let's say in this spot here, is a sell, doesn't mean that you're not going to get buy setups that happen. Because what do you think happens when we look at a cycle? When we look at a cycle like this, right, the EMAs are going to look like this. So you're going to have at least let's focus on the bigger ones, the 50, 200, and the 800. So the 50 is going to be like this. The 200 would be like this, and then the 800 would be all the way like this, right? So the trend, the bigger retail traders, they see this and they're like, oh, well, we're selling because the trend is to sell, right? And so the trend is your friend, so they want to sell. The problem is that they don't understand that price has already moved 3 times ADR, right? So they end up selling here to keep the trend going, but you should know better because it's 3 times ADR, so you're expecting a reversal. So whenever the big rule that I have is whenever the trend is obvious that a blind person can see it, it's time to start looking at, okay, did we pass 3 times ADR yet? Or are we close to 3 times ADR? Because if the trend is very obvious, everybody obviously is going to want to go with the trend, because every book tells you to go with the trend. Every retail trader's book tells you to go with the trend, right? So if you see a trend that's very obvious and you've reached 3 times ADR, 3.5 times ADR, I wouldn't be looking for selling, I'd be looking for buying. Especially if you notice like crazy stuff like this right here, like a spike, like a V spike like that, I'd definitely be looking for more buys, not sells. Well, the EMAs themselves, right, you're using them for different purposes. So think about it like this: if you don't use any of the EMAs, what are you going to use to help you confirm trades to enter? If you don't use the EMAs, you're essentially taking away a form of confirmation. Especially like, let's say, this would be a good example here of a type 1 pattern that's pinning to the 200. If you take away the 200, right, you take away basically a form of confirmation for you. So you want the EMAs there because they're just giving you an extra form of confirmation. So whenever I trade I'm looking for bounces off the EMAs if I can get them, because it just helps me confirm what I'm looking at. And it's especially true for me because I like to trade type 3 setups, and type 3 setups primarily bounce off the 50. So that's a really good form of confirmation for me. And you could see type 4s bounce off the 50. So continuation trades bounce off the 50. So there's a reason why we use them, or why they're there, because you can get good confirmations. Here's a type 1 multi-session type 1 setup here that you're using to confirm with the 200 EMA. So the EMAs themselves, you're using them for helping you confirm to get into trades for entry, right? You're using them to help you take profit, so you don't have to, do a trade where you're like, okay, where do I take profit? You just take them at the EMAs. So if you're taking a type 3 here on this day, you know that you're going to the 200 EMA, right? So if you go to the 200 EMA, you're going to get about 39 pips or so. Or if you didn't use the EMAs, you'd just be going for 30 pips. Same thing here on this one, a trade out of the edge. 30 pips is just right here, where if you're using the EMAs to take profits, you're able to target 56 pips. You can see here a type 3 trade, again, pins to the 50. Here, type 2 trade, second leg railroad track, goes all the way up. It almost makes it to the 200 or to the 800. That would have been your target here. So does that make sense of why you're using them? The reason that you're using ADR is you're trying to project out how far is price going to go before you get some type of reversal, right? If you can project out 3 times ADR, you're projecting out, okay, I'm thinking that price action should go somewhere in this area before I get, some kind of reversal. And if you can match that 3 times ADR with previous structure, so let's just say that, if you can map out the 3 times ADR, let's say from this reset down, and if we move this line up just to see where it's at here, and let's just go up to a 4-hour time frame, you can see that line goes straight through a bunch of structure that previously has happened back early in the year. If you go back even further, right from that line, you can see it goes through that structure there, and then goes all the way back to friggin' 2018, where there's structure there. So if you can project all this stuff out into the future, you'll know at least where you should be at, or where price should want to go to. But for the EMAs themselves, that's what we're talking about, on a daily basis, right, you're going to be using the EMAs mostly to just help confirm trade setups, whether they help you or don't, because there's going to be obviously times when it won't help you because the EMAs are not in that area. So like here, if you see that you're bouncing off a 200, you're spiking a 200 EMA, you got to ask yourself, why are you spiking a 200 EMA? Why don't you go through it? What's so magical about it? There's literally countless of examples where price bounces off EMAs. And so bouncing off of EMAs are just simply used to help confirm. think of the trade setups like type 1s, 2s, and 3s as a checklist. Think of yourself of having a checklist of, like, I don't know, maybe 5 to 6 things for each setup. So let's say if you're trading like a type 1, right? What are you looking for to help confirm that trade setup? I'd say obviously you're looking for the pattern, right? The timing. Those two things have to be in place, right? And then you can look for how many candles. So 5 or more candles. What else? Is it bouncing off? Or is it pinning, I should say. Pinning to an EMA. Do you have good confirmation on the TDI, which we'll talk about next? Second leg, let's say railroad track or star pattern. So think about what we just made here of a quick list. If a pattern or type 1 setups that you're trading have the right pattern, the right timing, 5 or more candles between the first and second leg, they're pinning to an EMA, the TDI helps confirm, and then the second leg gives you a railroad track or a star pattern. That's 1, 2, 3, 4, 5, 6 things right there that are helping you confirm that a trade setup is good. How confident would you be in taking a trade setup when all these factors are in play versus just having a pattern and timing in play? So if you had a type 1 setup that gave you a right pattern and right timing, and that's all it gave you, versus a type 1 setup that gave you pattern, timing, candles, pinning, TDI, second leg row, which trade are you taking? So now imagine that every time that you take one trade setup or a type 1 trade setup, you're following this list here, and if all these check, you take the trade. If they don't check, you don't take the trade. So we're going to talk about this in the back testing part, because when you have something like this in place, this allows you to look at the market in a very black and white way. It's either there or it's not there. If it's there, you take a trade. If it's not, you don't take a trade. So it takes your emotions out of trading. If you can take the emotions out of trading, you can have way better control over your wins and losses, and also your psychology. So key factors of the EMAs. On type 3 setups, you want to have a pin of the 50. Like for me, I don't take a type 3 setup that doesn't pin to the 50. On type 1 setups, you're not always going to get a pin to the 200, because clearly sometimes the EMAs are not going to be there to help you pin. But you see that there's going to be times right here where they are going to help you pin to the EMAs. And a lot of times you're going to notice this stuff as you're going into the London session. You're going to notice where the EMAs are. So if you're noticing that price action is pretty close to an EMA, you're probably thinking, hey, I would want to set up that pins to this EMA. If I'm looking for a sell, let's say, I don't know, let's say this right here, I'm looking for a sell here, and I see that the 200 is up here. Like, I wouldn't want price to come up here and pin that 200, because that would just give me a confirmation to take the trade down. But you can see, like, here it goes straight through. The 200 goes straight through it. You still get a pattern to trade. You actually get a second opportunity in the US session. This one here gives you a multi-session type 1 that you can take profit at the 50 or the 200. This one's same thing. This one is a US type 1 going up to the 50 as a take profit. Yeah, you measure it up to 3 times, right? So you take that number and you times it times 3. So you take 94 and you times that times 3. And that gives you about 282 pips. So generally speaking, around 282 pips is what you should expect pound USD to move in one direction without getting a pullback. So somewhere around there. If they want to push it a little bit higher, I've seen them go up to 4.5 times ADR. So that's what I was saying yesterday. The range. So in a perfect world, right, it would always be 3 times ADR. But we're not living in a perfect world. So the ranges that I've seen them go is from 2.5 all the way up to 4.5 times ADR. The sweet spot obviously being 3 times ADR. Brian, no, that's it's the average daily range, not the Asian range. The Asian range is right above it, which is 24. So right now it's about 94 for this pair specifically. Every pair is different. So if you go to a different pair, you'll see that this one for Euro USD right now is 57. If you go to Euro NZD, it's 136. So every one of them is going to be different.
Alright guys, welcome back. I hope you got some value from that particular video. Please let me know in the comments what you're thinking about the series, guys, so far. Also, please do me a favor, like and subscribe to the channel, guys. It helps out with the YouTube algorithm. Thank you so much, and we will see you in the next one. Guys, if you need any more help or you like the content that we provide on this channel, come on over to the FXN Masterclass. It's available right now. What you get essentially is a lifetime membership, a full mentoring course, an advanced course. You get the Blue Summit videos, weekly Q&A sessions every Sunday, group session archives, which that by alone has about 100 hours of content, weekly analysis videos, midweek analysis videos, MT4 and MT5 indicators, a customized trading journal so you could actually journal your trades every day, and then a backtesting journal that you can use to backtest and collect all of your data. Not to mention a mentoring private chat, guys. So all the information is in the link in the description if you want to join now. We look forward to seeing you there, guys, and take care of yourselves.